We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
As the stock market continues to reach new highs, it's tempting to think about the possibility of buying and selling at just the right moment. But here's a dirty little secret that most of the investment industry doesn't want you to know. Time is more important than timing in investment success. A good example of this comes from an analysis described by a famous mutual fund manager named Peter Lynch, and he goes over the effects of market timing on performance over a 30-year period from 1965 to 1995. The way he describes the study is that if you had invested $1,000 on the lowest day of the market in each and every year, you would have earned an annual average return of 11.7%. On the flip side, if you had invested at the market high each year, you would have earned a return of 10.6%. And finally, if you'd simply invested $1,000 at the start of every year, you'd have earned a return of 11% per year. So just to recap those findings, perfect market timing return was 11.7%. Worst market timing return was 10.6%. No market timing return was 11%. There's a few takeaways from this simple study on market timing. The first is that the reward for perfect market timing is pretty small, considering that it's impossible to consistently time market movements over long periods of time. Again, the perfect market timing return is 11.7% versus the no market timing return of 11%. So again, real small reward for that perfect market timing over long periods of time. The second thing to point out is that the average returns were achieved because the investor never sold in down markets and allowed the returns to compound over time. These returns, they weren't achieved because the investor sidestepped the many downturns that occur over the periods that they experience. The average returns, they include both the really good times and the really bad times. And that's sort of similar to another study that is part of one of my all-time favorite blog posts from Ben Carlson, that he shows a similar analysis in which an investor only invests at market peaks, but never sells. And I'm going to try to summarize Ben's analysis as best as I can, but I'll certainly provide a link in the show notes too. Just go to thelongterminvestor.com to find those. So Ben creates this narrative around a guy named Bob, the world's worst market timer, who's a really good saver, but only has the courage to invest his savings when the market's doing well, which just so happens to coincide with market peaks. And I think that's really every investor's worst nightmare, investing a bunch of cash at a market peak. So anyways, Bob starts his career in 1970 at age 22 and saves $2,000 a year during the 1970s. Then he increases his annual savings by $2,000 every decade as his salary rises. This means he's saving $4,000 per year in the 1980s, $6,000 per year in the 1990s, $8,000 per year in the 2000s, and $10,000 per year in the 2010s up until retiring in 2013. But remember, he only invests at market peaks, the first of which comes at the end of 1972, after he's accumulated $6,000 in cash at the bank. So he invests this in the S&P 500, and then unfortunately the market proceeds to lose half its value in 1973 and 1974. But fortunately, he never sells his investments. But also, unfortunately, he's too nervous to add additional funds to the market, so he directs his savings to cash at the bank. It isn't until August of 1987 that Bob feels good about the market again. He's accumulated $46,000 in savings at the bank, and again, he invests that money into the S&P 500, and again, he watches the market crash. But again, fortunately, he never sells any of his purchased shares, but he does revert back to saving into cash at the bank. The next time Bob feels the future looks bright is December 1999, at which point he has $68,000 of cash to invest. His purchase in December 1999, again, was unfortunately followed by a 50% downturn that lasted until 2002. Again, Bob never sold, but he also made that switch of his annual cash going into the bank until he gets to $64,000 in October 2007. True to form, he invests at the market peak and watches the S&P 500 fall over 50%. He's planning to retire in 2013, so that was his last investment. He never makes another stock market investment, and he directs all his remaining years of savings into his trusty cash account. Despite the awful market timing, Bob ends up with $1.1 million at retirement, which I think is pretty good, given that he only saved $184,000 over the course of his career and always invested at the absolute worst times. The thing here is that although he's consistently investing at the top of the market, he really did have two things going for him. The first is that he never sold his investments despite the market routinely crashing. And that's actually true in the Peter Lynch study too that I referenced earlier. Even though Wall Street would like you to believe that investment success requires a complex strategy, it's time and the power of compounding that are going to be the biggest drivers of building wealth through investments. It's easy to come up with reasons why the market might crash, but it's important to remember that stock investors are compensated for assuming the uncertainty of short to intermediate stock returns. So in order to receive a rational premium for owning stocks rather than bonds or cash, stocks occasionally have to lose value. If you stay invested through all market environments, time is going to reward you for your patience. Now, the second thing worth noting in the Bob the World's Worst Market Timer scenario is that Bob's consistent savings plays a really big role in him accumulating all that wealth by retirement. So if Wall Street's biggest secret is that time trumps timing, then the secret that comes in a close second is your savings rate is far more important than your rate of return. And the beauty of this secret, though, is that your savings rate is something you can totally control. Now, I'd like to highlight one final study. This one's a little more recent and may now be my favorite. Charles Schwab published an article titled, "Does Market Timing Work?" that shows the cost of waiting for the perfect moment to invest can be a pretty costly one. And if you're a regular reader of mine, you know that I believe it's far better to plan for the unknown future than it is to try to predict it. This research, which I'll link to in the show notes, is another great illustration in the importance of developing a plan and investing accordingly. The research looks at hypothetical performance for 5 different investors over a 20-year period ending in 2020. Each hypothetical investor receives $2,000 at the start of the year. And so here's how the different investors invest it. The first has perfect market timing such that the $2,000 invested at the low point for the S&P 500 each calendar year. The second investor immediately invests their $2,000 on the first trading day of the year. The third investor uses dollar cost averaging by dividing up the annual $2,000 allotment into 12 equal portions, which are invested at the beginning of each month. The fourth investor has perfectly bad market timing, meaning that the $2,000 is invested each year at the highest closing level for the S&P 500. And then the final investor, they leave their money in cash and wait for the better opportunity to invest, always convinced that lower stock prices are just around the corner. Now, if we look at the 20-year results, it's no surprise that naturally the best results belong to the investor that's the perfect market timer. That investor finishes with $151,391. But like the other studies we've seen, that perfect outcome wasn't that much better than the next best performer, which was the investor who invested immediately the $2,000 on the first trading day of each year. In fact, the perfect market timing over a 20-year period only resulted in $15,920 more than investing immediately. And for what it's worth, the next best performer was dollar cost averaging, which trailed the immediate investor by just $615. Now, as you'd expect, the investor with the perfectly bad market timing, the one that always invested at the annual market peaks, trailed the perfect market timer and the immediate investor and the dollar cost average investor. But the most important takeaway is that the investor with the absolute worst market timing ended up with nearly 3 times as much as the investor who just stayed put in cash. Now, maybe you think the data is cherry-picked or that it's time period dependent, but that's not so. The researchers at Charles Schwab ranked these different investment strategies over 76 rolling 20-year periods going back to 1926. And the rankings were identical in 66 of those 76 rolling periods. For those other 10 periods where the rankings were different, investing immediately never came in last place. It was second place 4 times, third place 5 times, and fourth place only once. And for what it's worth, the second, third, and fourth place returns were all virtually tied in each of these different rolling periods. But the research doesn't stop there. They also look at all possible 30, 40, and 50-year time periods starting in 1926. And there's only a few instances where investing immediately isn't the second best outcome to perfect market timing. And in those very few instances where it wasn't, dollar cost averaging was the next best outcome. In all iterations and all time periods from this research, never once was buying stocks the worst outcome. So I'll leave you with a few takeaways from this study. For starters, if you're tempted to wait for the best time to invest in the stock market, the benefits of doing so, assuming it were even possible to time it correctly, aren't really that impressive. Remember, the perfect market timer in this study finished with just above $151,000 compared to the investor that immediately invested each year, and that investor had about $135,000. So we're talking about $15,000 of difference. Knowing that it's nearly impossible to accurately identify market bottoms on a regular basis, this extra $15,000 or so really isn't that much additional reward for assuming the very high likelihood that you will time the market incorrectly. The other big takeaway from this study, in my opinion, is that if you're sitting on cash waiting for the right time to invest, the evidence suggests that the best course of action is to develop a plan that allows you to take action as soon as possible. So what's the secret to timing the market? It's just that. It's developing a plan that helps prevent procrastination, minimize regret, and avoid market timing. Because even the worst luck with your investment timing isn't nearly as bad as the high cost of waiting to invest. For show notes, free resources, and a place to submit questions, please visit thelongterminvestor.com. And if you're enjoying the show, you can subscribe wherever you listen to podcasts. And please take time to leave me a review. I'm reading every single one, and I really appreciate you taking the time to let me know what you think. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.